this video, we are going to talk about the 5 biggest questions you should consider before investing your money. If you or someone you know is sure that they want to start investing their money but aren't confident enough in their abilities to begin doing so, then you've come to the right place. By the end of this video, you'll be able to assess your situation through these questions and figure out exactly what kinds of investments would suit your situation best. Welcome back, Money Masters! It's another Wealthy Wednesday, where we open the kimono and reveal the secrets that the wealthy elites have been using for decades to generate massive amounts of passive income through entrepreneurship and investing. As we mentioned earlier, today we are going to be talking about the 5 biggest questions you should consider before investing your money, which will help you assess your situation through these questions and figure out exactly what kinds of investments would suit your situation best. But before we dive in, I just want to let you know that on Friday, we will be discussing how you can apply for credit cards without endangering your credit score. So, if you don't want to risk missing out on that episode, make sure to subscribe to our channel and hit the bell icon so that you can be notified of our next amazing video. Okay, with all that said, if you are just like us and you're totally committed to obtaining financial independence, then go ahead and tap that like button and let's get into it. If you have been watching videos about personal finance for a while now, you are now familiar with the adage that investing your money is one of the best ways to multiply your wealth. That is true, and it is always a good idea to consider investing money you have not already allocated to the essentials and savings, but a lot of people today still ask about what they should invest. While we do want to help you out, however, we can. The unfortunate truth is that what you should invest in depends on your situation. Remember, what might be a gold mine for a friend of yours might just be a financial pitfall for you. You need to think carefully about what works for you and what does not, or else you just might be throwing your money away. With that said, we have 5 questions that you can ask yourself to get a better picture of what kinds of investments you are going to be up for. Question number 1. How much am I willing to lose? Many people think that they should consider how much they want to make through investing. However, contrary to that, the very first question you should be asking yourself when choosing what to invest in is just how much you are willing to lose while putting in your money on the line through investing in the first place. Think of it like this. If you had, say, $2,000 in your investment fund, ask yourself how you would feel if you lost 100 of those hard-earned dollars. How about $400? What if you ended up losing half of the money you set aside for investments? Would you personally be able to manage such losses? Your answer to these questions will allow you to figure out how much risk you are willing to take on. Knowing your risk tolerance lets you choose your investments more wisely so that you don't end up giving into loss aversion, the tendency for people to avoid losing money instead of gaining money. Purely because for many, the psychological pain of losing your money is twice as strong as the hit of happiness that you get when you turn a profit on your investments. Question number 2. What is the goal or purpose of this investment? The next factor we need to ask a question about is the purposes of your investment. Are you investing because you want to earn money for your retirement? Are you building your child's college fund, or do you just want some money to buy a car? Whatever the case is, the reason you are investing has the potential to change the best investments you can make. Why? Because each goal is unique and has its timetable or deadline. If you are planning to get money to buy a car or a phone, then you are looking to earn that money within a year or 2. In that case, the best investment vehicles and financial instruments you will want to put your money in will be the safer options like bonds, time deposits, or certificates of deposit. However, if you're looking to achieve a goal that runs much farther into the future like a retirement fund, college fund, a house, or simply want to invest for the long term, you are going to want to look at something different. These kinds of goals can sometimes have a timetable lasting around 10 years or so, and that leaves you some leeway to go after more aggressive and higher risk, higher reward investment vehicles like stocks and real estate properties. The longer investment time means that your money has more time to grow and has a higher chance of increasing overall, while also having more chances to protect against those occasional dips in value you will observe. This way, you can start to make use of the longer timeline to put yourself in the best position so that you can maximize your reward while giving your investments more chances to recover from their dips in value. Question number 3. Why would I sell this investment? The third question that you should ask yourself pertains to exactly what types of circumstances you would be selling your investments. By considering and finalizing the exact circumstances or reasons you would sell your investments, you can help protect yourself from panic selling that has historically cost investors large sums of money. If you, as an example, choose to own an investment for at least 10 to 12 years and only choose to sell it if its value drops below 90% of the original or exceeds that original value by a predetermined amount, then you'll have a more defined condition that would allow you to stay calm more easily because you know exactly when you're going to liquidate your investment. Moreover, deciding on the sell conditions of the investment will also allow you to have a better idea of the investments that you want, which will help you vet out the ones that are not as conducive to your situation. Now, given that, it is okay for you to bend those conditions at times. There is a degree of nuance in all situations in life after all. Question number 4. How much will this investment cost? Next up, you will want to ask yourself what a particular investment that you are considering will cost. A quick search on Investopedia reveals that there are often hidden costs in investing that goes unnoticed by many investors. For example, mutual funds often charge you an amount that is based on the returns you are getting from them, called an expense ratio. If you invest in a mutual fund with an expense ratio of 1% and it returns 9% at the end of the year, then you are only going to receive 8% of the returns. An additional fee for sales in the form of a front-end load may also be charged depending on the service being used. There are also annual and custodian fees that on average can range from $25 to $90 per year, which is not a lot but does add up. Sometimes a stock trading service charges a per trade fee instead, which is simpler and easier to understand but is something to look out for. Moreover, hiring investment advisors will bring in more costs that you will have to watch out for as well, so you're going to want to consider whether hiring one is worth it. At the end of the day, the best way to minimize these costs is to do your research and choose the investment options that have as few as these additional fees as possible to maximize the returns you get on your investments. Question number 5. Am I diversified? Lastly, you need to ask yourself if your investments are as diversified as you are going to want them to be. Now, I understand if you'd like to mostly deal with a particular kind of investment, like say stocks, bonds, or real estate, but even within those types of investments, some level of diversification is going to be essential if you want your finances to survive economic downturns and other unforeseen circumstances that would see your investment values dropping. Nothing is ever a 100% guaranteed way to earn money in the real world, so putting all your eggs in a multitude of baskets compared to a single one is always going to turn out better eventually in the case of some of those baskets breaking. The important thing is that you ensure your finances cannot go down the drain just because a single company went bankrupt or got caught in some sort of controversy or scandal. For example, what if you put all of your money into establishing a small business only for that business to go bankrupt for a variety of reasons? All your money would be gone just like that. Even real estate is not a foolproof plan for wealth because housing markets could crash because of circumstances and factors that are out of your control. The important thing to take away from this is that you should evaluate your profile and ask yourself whether your money could go up in smoke if one form of investment in your portfolio goes bankrupt. If the answer is yes, then it is best to start spreading that money elsewhere. Remember, balance is key, so when you're deciding on what to invest in, you should consider whether your portfolio will still be diverse once your newest addition is factored into the equation. So that's all we have for you today. We hope you learned some very helpful insights from what we've shared with you today. Please don't forget to leave a like on our video if it was able to help inform and positively influence your financial decisions and lifestyle, and leave a comment down below about how you feel like this video will help you boost your overall income. Also, if you love our content, subscribe for more Money Masters content and updates, and so that you don't miss out on our next episode of Finance Friday, where we will be discussing how you can apply for credit cards without endangering your credit score. Also, we'd like you to consider sharing this video with at least one friend. It would mean the world to us if you would join us in our mission of helping good people like you keep more of what they earn and earn more from what you keep. That'll be all from us in this video, Money Masters. We'll see you in the next video.